Why are you interested in pursuing a career in investment banking? I am passionate about pursuing a career in investment banking due to its dynamic nature, where analytical skills meet strategic decision-making. The fast-paced environment, complex financial transactions, and the opportunity to contribute to key business strategies greatly appeal to me. I am excited about delving into financial modeling, mergers and acquisitions, and capital market transactions. The chance to work on high-impact deals, collaborate with diverse teams, and continuously learn in a challenging setting aligns with my professional goals and enthusiasm for the financial industry's intricacies. What are the different types of investment banking? Investment banking encompasses various specialized areas, each serving distinct functions within the financial sector. The main types of investment banking include mergers and acquisitions, Manda advising companies on buying, selling, or merging with other companies to achieve strategic goals. Capital markets, facilitating the issuance of securities, including initial public offerings, IPOs, and secondary offerings, connecting companies with investors. Corporate finance professionals focus on providing financial advice to corporations. This includes capital structure optimization, determining the appropriate mix of debt and equity, and managing financial risks. Restructuring and distressed Manda, specialists in this area assist companies facing financial distress or bankruptcy. They help restructure debt, negotiate with creditors, and explore strategic alternatives to enhance the financial health of distressed companies. Private equity. While private equity firms themselves may not be considered investment banks, they often collaborate closely. Private equity professionals engage in buying and investing in private companies, often with the goal of improving operations and selling them for a profit. Equity research. Equity researchers analyze financial data, industry trends, and company performance to provide insights and recommendations to institutional investors. Their research helps investors make informed decisions about buying or selling stocks. Sales and trading, buying and selling financial instruments on behalf of clients, managing risk, and providing liquidity in the markets. Asset management, managing investment portfolios on behalf of clients, including individuals, institutions, and funds, to achieve specific financial objectives. Project finance bankers focus on structuring and financing large infrastructure projects, such as power plants, transportation systems, and natural resource developments. They assess project feasibility, risks, and financing options. Real estate investment banking. Real estate investment bankers deal with financing, mergers, and acquisitions related to real estate properties. They work on transactions involving commercial and residential real estate, as well as real estate investment trusts, REITs. Technology, media, and telecommunications, TMT banking. TMT bankers specialize in advising companies within the technology, media, and telecommunications sectors. They assist with mergers, acquisitions, and capital raising specific to these industries. Explain your approach to valuing a company. Valuing a company involves various methodologies, but I typically use discounted cash flow, DCF, analysis, comparable company analysis, CCA, and precedent transactions. DCF assesses a company's intrinsic value based on future cash flows, while CCA compares key financial metrics with similar publicly traded companies. Precedent transactions analyze the valuation multiples of past deals in the industry. Can you describe the major financial statements and their interconnections? The major financial statements are the income statement, balance sheet, and cash flow statement. The income statement reflects a company's revenues and expenses, while the balance sheet shows its assets, liabilities, and equity. The cash flow statement details the cash inflows and outflows. They are interconnected as the net income from the income statement affects the equity on the balance sheet, and changes in balance sheet items impact the cash flows. Take me through the components of the income statement. The income statement outlines a company's financial performance over a specific period. It starts with revenue, deducts the cost of goods sold, COGS, to determine gross profit, then subtracts operating expenses, like Sagandha, interest, and taxes to calculate net income. How do you calculate the cost of equity? The cost of equity can be calculated using the capital asset pricing model, CAP. Cost of equity is equal to risk-free rate plus beta, market return risk-free rate. Explain how WACC, weighted average cost of capital, is calculated. WACC is calculated by multiplying the cost of equity by its weight in the capital structure and adding the product to the weighted cost of debt. The formula is WACC is equal to E by V multiply cost of equity plus D by V multiply cost of debt multiply of 1 minus tax rate, where E is the market value of the company's equity, D is the market value of the company's debt, V is the total market value of the company's equity and debt. Cost of equity is the expected return on the company's equity. Cost of debt is the interest rate on the company's debt, and tax rate is the corporate tax rate. What is the formula for enterprise value? Enterprise value, EV, is calculated as the sum of a company's market capitalization, debt, minority interest, and preferred shares, minus cash and cash equivalents. The formula is EV is equal to market cap plus debt plus minority interest plus preferred shares cash and cash equivalents. Define EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a measure of a company's operating performance, providing a snapshot of its ability to generate cash from operations. What is an IPO? An IPO, or initial public offering, is the process through which a private company becomes publicly traded by issuing shares of its stock to the public for the first time. This allows the company to raise capital from public investors. What is SIP? SIP typically stands for Systematic Investment Plan, a strategy where an investor regularly invests a fixed amount of money in a mutual fund or stock at regular intervals, regardless of market conditions. This approach helps in rupee cost averaging and mitigates the impact of market volatility. What is a mutual fund? A mutual fund is a pooled investment vehicle that collects money from many investors and invests in a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, mutual funds offer individual investors the opportunity to access a diversified portfolio without having to directly buy and manage individual securities. Define risk. Risk refers to the uncertainty or variability of returns associated with an investment. It encompasses the possibility of losing some or all of the invested capital and is influenced by factors such as market volatility, economic conditions, and specific company performance. Explain trade data and settlement data. Trade data involves the details of a securities transaction, including the buy or sell order, the quantity, price, and time of execution. Settlement data refers to the process that follows where the actual exchange of securities for cash occurs. Settlement involves the fulfillment of contractual obligations, ensuring that securities are delivered to the buyer and payment is made to the seller. Can you discuss a recent deal or transaction you worked on? In a recent transaction, I was involved in facilitating the acquisition of Company X by Company Y. My role included financial modeling, conducting due diligence, and preparing presentation materials for client meetings. This deal allowed Company Y to expand its market share and product offerings strategically, and I learned valuable insights into the Manda process. What are the different valuation methodologies? Valuation methodologies include the discounted cash flow, DCF, analysis, comparable company analysis, CCA, precedent transactions, and the market approach. Each method provides a different perspective on a company's value, considering factors such as future cash flows, comparable company metrics, and historical transaction data. How would you approach a discounted cash flow, DCF, analysis? To conduct a DCF analysis, I would project the company's future cash flows, determine the appropriate discount rate, WACC, and then discount those cash flows back to their present value. By summing the present values, I would arrive at the intrinsic value of the company. This method provides insight into the potential worth of an investment based on its expected future cash generating capacity. What is the difference between equity and debt financing? Equity financing involves raising capital by issuing shares of ownership in a company, stocks, while debt financing involves borrowing money that must be repaid with interest over time. Equity provides ownership stakes to investors, entitling them to a share of profits and voting rights. Debt, on the other hand, creates an obligation to repay borrowed funds within agreed-upon terms. How do changes in interest rates affect the valuation of a company? Changes in interest rates impact the cost of capital. When interest rates rise, the cost of debt increases, potentially lowering a company's valuation due to higher discount rates in valuation models. Conversely, falling interest rates may reduce the cost of debt and elevate company valuations. When should a company consider issuing debt instead of equity? Companies may prefer issuing debt when they want to leverage their capital structure without diluting ownership. Debt allows companies to raise funds with a fixed obligation to repay, whereas equity involves sharing ownership. If a company believes it can generate returns on investment higher than the cost of debt, issuing debt might be favorable. How would you value a company with negative historical cash flow? When valuing a company with negative historical cash flow, I would focus on future cash flow projections and the potential for positive cash flows. Emphasizing long-term growth prospects, assessing industry trends, and considering the company's competitive position would be crucial. Additionally, evaluating management strategies and the likelihood of turning cash flow positive in the near future would play a significant role in the valuation process. How do you compute unlevered free cash flows for DCF analysis? Unlevered free cash flows are calculated by starting with the company's operating income, adjusting for non-cash expenses, changes in working capital, and capital expenditures. The formula is, unlevered FCF is equal to EBIT, 1 tax rate, plus depreciation and amortization changes in working capital expenditures. What characterizes a typical leveraged buyout, LBO, transaction? An LBO involves acquiring a company predominantly using debt financing, where the assets of the target company serve as collateral for the borrowed funds. Private equity firms often lead LBOs, aiming to enhance the target company's performance, reduce costs, and eventually sell it for a profit. What are the primary factors driving the need for mergers and acquisitions? Companies pursue mergers and acquisitions for various reasons, including expanding market share, achieving synergies, entering new markets, diversifying products or services, gaining cost efficiencies, and responding to industry changes or competitive pressures. How would you evaluate the financial health of a company? I would assess financial health by analyzing key financial ratios, such as liquidity ratios, current ratio, solvency ratios, debt to equity, profitability ratios, net margin, and efficiency ratios, inventory turnover. Additionally, a thorough review of the company's financial statements, cash flow, and overall business strategy would be essential. If a company is contemplating a merger, what factors would you analyze? I would analyze factors such as strategic fit, synergies, potential cost savings, cultural compatibility, the financial health of both companies, regulatory considerations, and the impact on market share. Assessing the potential risks and benefits of the merger is crucial. Explain the concept of leverage and its impact on financial performance. Leverage involves using borrowed funds to amplify returns. Financial leverage, measured by the debt-to-equity ratio, can enhance profitability in good times but increases risk during downturns. High leverage magnifies both gains and losses, impacting a company's financial stability and return on equity. Distinguish between accounts receivable and deferred revenue. Accounts receivable represents money owed to a company by customers for goods or services delivered but not yet paid for. Deferred revenue, on the other hand, is the advance receipt of payment from customers for goods or services the company has yet to deliver. It's a liability until the obligation is fulfilled. What happens to earnings per share, EPS, if a company decides to issue debt to buy back shares? If a company issues debt to buy back shares, the reduction in the number of outstanding shares typically results in an increase in EPS. This is because earnings are distributed among fewer shares, leading to a higher EPS, assuming that the company's net income remains constant. What is the current state of the global economy, and how might it impact the financial industry? The current state of the global economy is influenced by factors such as economic growth, inflation, and geopolitical events. These factors can impact interest rates, market volatility, and investor sentiment, which, in turn, affect the financial industry's performance and strategies. How do recent economic trends impact the investment banking industry? Recent economic trends can influence the demand for financial services, the volume of mergers and acquisitions, and the overall health of capital markets. Economic downturns may lead to a decrease in deal activity, while economic upturns could result in increased investment and financing opportunities. Name a few major players in the investment banking industry and explain their roles. Major players include Goldman Sachs, JP Morgan Chase, Morgan Stanley, and Bank of America Merrill Lynch. These banks provide a range of financial services, including advisory services for mergers and acquisitions, underwriting securities, and managing complex financial transactions. Discuss a recent financial regulation in the news and its impact on the industry. An example is the Dodd-Frank Wall Street Reform and Consumer Protection Act. It aims to prevent a repeat of the 2008 financial crisis by implementing regulatory changes, enhancing transparency, and imposing stricter oversight on financial institutions. These regulations impact how investment banks operate and manage risk. Please refer to our previous videos for more banking interview questions with answers.